introduce Julie, and a few of you already know Julie in different networks, and maybe you've heard Julie speak before, but she's a business growth coach with a really credible, long experience of supporting female founders as a qualified accountant, a financial director, and a financial planning professional. And I know that Julie's worked with large organizations as well as being an entrepreneur herself. So I'm going to stop sharing my screen now and allow you to get yours up, Julie, and over to you.
Okay, let's see how this goes. Is that working? Looks like it's working at my end. Can you see it? Yeah. Okay. Thank you, Elaine. Sorry, because you're on mute. I need to saw you nodding just now. Thank you. Let me just close my screen so I don't see I'm talking. Right. Okay. Thank you, everybody. I shall do my best. I confess I've been talking since 9 o'clock this morning. I've been lecturing like students. It's just like mind-blowing. So hopefully I'll make it as clear as I can with regards to finance. So it's not letting me change my, there. Okay. So when it comes to businesses, the two classic examples of a business structure will dictate kind of what accounts that you need to know. So the two kind of obvious categories are sole trader and limited company. And then beyond that, you do have your CICs, which are social enterprises and charities, and you have various structures that are in between. But the high level distinction between the two is a sole trader and a limited company. And the obvious one is sole trader for people that are starting up early on in their business, because it could be where they are doing a side hustle to begin with, or they're not big enough and they're experimenting, and so they want to go as a sole trader. But then people then progress to being a limited company. You don't have to start off as being a limited company. It's easy to go up the chain of complexity rather than go back down again. So you can start off as a sole trader and then move up the chain of being limited companies, CICs, etc. But it's more difficult to go backwards and kind of become more simple in structure. Now, the obvious way of thinking about how a sole trader business looks like is legally and also in the eyes of HMRC. And for those who are abroad, I don't know what the different structures are, but in the UK, HMRC is our tax authority. And when you're a sole trader, you only need to notify HMRC that you are actually trading. And in this instance, you are deemed to be, with you and your business, one and the same entity. So I think of a business as being your baby, because it's your little baby that you've set up and you want to look after. But when you're a sole trader, it's like you're still pregnant. You and the business are still one entity. So what goes into you financially and what comes out of you is all one entity. But when you are a limited company, this is where you've actually given birth to your baby, and you are two separate entities at this point. And so when you do this, you then have to register as a limited company with Companies House as well as HMRC. And this is when the assets between you as an individual and you as a business are then separated. And the first thing you need to do is, when you set up a business, irrespective of your structure, is I definitely recommend that you set up a business bank account, even if you're a sole trader, because this then makes you more disciplined in running your business finances, and it doesn't get messy with regards to all your personal finances. So you don't want your weekly shopping getting mixed up with your business finances, because then it makes it very difficult to disseminate how successful your business actually is. So from a discipline point of view, from a data point of view, and it makes it much easier should HMRC start investigating you for any reason whatsoever, you can then justify what you do as a business, and then what is you as an individual. So obviously you need to set up lots of business bank accounts, and typically you could go for one of the, the high street banks, or you can have one of what they call the challenger banks, which are very popular. And there are lots of functionalities behind the challenger banks if you're setting up. but also there are some limitations around, customer service, that you don't get to speak to a person, etc. So it is a real case of whatever suits you. And at the end of the day, a lot of the challenger banks are underwritten by the larger banks anyway. So you'll see that, a lot of them are underwritten by Barclays or Santander or something like that. And even something like the Metro Bank is also, even though it's a high street bank and it's not a challenger bank per se, there are some credibility issues around that as well. So you've got to make your own decisions around which bank you choose. There is no one size fits all. It's definitely down to individual preferences. So with regards to what you need for accounts, typically people think of accounts as being balance sheet and the income statement, or what they call profit and loss. We call it profit and loss in the UK. This is an American slide. It therefore calls an income statement. So I think of a balance sheet and the profit and loss as like a married couple, because when you do something in your business, it can affect one or both of your statements. The cash flow statement, which is called in this instance, now the cash flow statement is a specific document in the UK that gets filed when you are a larger company, and it's basically a summary of what cash has actually done. But it's not something that people at business level tend to use. It tends to be something that the accountants prepare for businesses at the year end, and even accountants. I mean, even when I was doing them, I had no idea what the purpose of it was. So, and the accountants these days still go, I don't know why we do this. So I wouldn't worry about the cash flow statement per se, but what I would emphasize that businesses need to use is a cash flow forecast, which is a very different statement. Now, with a balance sheet and the profit and loss, they go hand in hand, like a married couple, as I say. So when you are a small company, you're a micro entity, you get to file a minimum of a balance sheet. And if you're bigger, then you file the balance sheet and a profit and loss. And as you're even bigger, then you file the cash flow statement. Now, what they have different significances. A balance sheet tells you what a business is worth at any moment in time. It is really fixed at a particular day. So when you see a balance sheet, it typically says a balance sheet as at, say, for example, 30th of June. If you have a June year end, it will be for the year ended 30th of June. And the corresponding profit and loss statement would say the profit and loss for the 12 months or year ended 30th of June, because it will cover a 12-month period. And the balance sheet and profit and loss, think of it like a sandwich, because the difference in your business in value will change year on year, month on month, and it will change through, and it will be demonstrated through your profit and loss. So, for example, your opening balance sheet as at the 1st of July 2023, could say it's worth £5,000. And then for the profit and loss for the year ended in June, for the 12 months, you could have made a £3,000 profit, for example. So your year end value will be £8,000, because you were worth £5,000 at the beginning of the year. You made a profit of £3,000. So you as a business are now worth £8,000. So I think of it like a sandwich. So your opening balance sheet plus your profit and loss for the period gives you your closing balance sheet. So that's how you can view it. And that is a sort of, in simplistically, how they go together. And if you understand that, then you have a greater sense of when you're spending money or when you're bringing money into the business, how that affects your profit and loss and how it affects the value of your business in a balance sheet terms. So both of the balance sheet and the profit and loss are historical. They look at what's happened in the past for the past 12 months or for the past month if you're just doing management accounts for a monthly basis. The cash flow forecast I'm talking about it's dependent on the activity that's going on in the business, but actually it becomes a forward-looking document. And I'll show you an example of one in a minute. And so I think of that as an independent statement. So it doesn't matter exactly, you know, how things go on in the rest of the business. If you have any questions around that, I'll come back to me at the end, and I'll explain it a bit better if I've confused you. So this, for example, is a cash flow forecast. So the reason why a cash flow forecast is really useful is because cash is absolutely vital to your business. And I think of cash as being the oxygen to your business, because the minute you run out of cash, your business will stifle and die, in the same way that, you know, us, you know, if we run out of oxygen, we will just die. So if you know what your cash is doing, then you can start decisions off the back of how to run your business a bit better to make sure that you are not running out of cash. Because more businesses go bankrupt and into liquidation through lack of cash rather than lack of profitability. Because cash you need in order to pay for all your expenditure as it falls due. Doesn't mean you're not profitable in the long term, but if, for example, you sell something and you sell it for £1,000, but you need to pay your suppliers and you need to pay your rent and you need to pay your staff, and you don't have the money to pay them, you can actually go bankrupt for that reason. It doesn't matter the fact that you've got a contract to be profitable. So a good example of this would be something like the building industry. You may have a building, you could make, you know, several million off selling a building at the end of it, but if you haven't got the cash to pay for the building of it, your contractors, your build the land site, and all the materials, the building materials, doesn't matter, because if you haven't built the building, you're not profitable at the end of the day. So that's why you need to manage your cash. So it is the oxygen to the business, and think of it that way. And you need to know how long your cash will last you so that you can make sensible decisions. So a cash flow forecast, if you see the example in front of you, how it looks like, it's basically, I think of it as a dynamic document. So in the top row, it says your opening bank balance, and then it go down and so you bring in all the money that you've got coming in, so your cash inflow. So you've got your total cash, what you stands at, and then with all your expenditure, you then show all the money coming out, so that at the bottom of it, you have what you think your closing bank balance will be. The cash flow forecast is useful to try and emulate, predict what your cash bank account will look like. So which is why it's a forecast, and it is estimates. So when you do it, you forecast. I recommend that you forecast for 12 months, because it gives you a long view of the road ahead of you. So you don't want to be going like, oh, what's my cash balance looking like next month? You want to be looking further down the road, 6 months, 9 months, 12 months. So what you do a forecast for 12 months, and at the end of each month, what you do is you then update the numbers for what your cash income actually was, and what your cash going out actually was. Because the reason why you want to do that is because your closing balance then feeds into the top line again and becomes your opening balance. And because it does that, it will then show how your performance in the current month will impact you further down the line. So you might have forecast that you might have a big contract coming in and they pay you. And so you are going to be quite comfortable in the future. But if for any stage something changes and your contract doesn't happen, they may go bust or they cancel the contract, it might put you in what I call a sticky bum moment somewhere in the future. And if you know that in 6 months' time, ahead of time, that you were running quite close to the wire, and if you have a seasonal business, this is always good to know, because sometimes you are very reliant on every single pound that comes into your business. And this helps you make really sensible decisions. So I was talking to a client, and he told me a story about him managing his cash. And he had a piece of equipment, so he knew that he was running out of cash. But because he knew ahead of time, he was able to sell a piece of equipment in order to fill that cash gap that he was going to experience. Now, because he knew that he had a bit of time to fill this gap, he did not have to do accept the first offer that was accepted, because the first person that offered to buy this piece of equipment from him offered him something like 25 or 30% below market value. And because he knew ahead of time, he was able to then hold out for a better offer. But had he been in a situation where he actually needed that cash, he would have had to accept that short-term offer. And so as a business owner, if you need cash further down the line, you can get better loan rates, you can secure overdrafts, whereas when you actually need it, they're much more reluctant to give you those sort of preferential interest rates on. The offers might not be available to you because your credit rating might have gone down, and you do not look nearly as lucrative on paper. So it's quite a good way for you to manage your cash further in advance. So for example, in this instance, 6-7 months down the line, this business owner can see that they are going to go into the red, and therefore they need to do something now about what they can do going in the future. So it could be bringing on finding new customers, replacing new contracts, and knowing what you can do with your cash balance. If opportunities come up, you have cash and you can afford these opportunities. Or if you lose an opportunity, then you need to know what you can do when it's going to hit you most in the worst case scenario. So this is what you kind of need to do in order to make better decisions. This is why cash flow forecast is one of the most essential documents for making good decisions around your business. So looking like financial management, I always think business owners need to educate themselves. It isn't a case of, I don't understand finance, I'll leave it to somebody else. Because as a business owner, I think finance is the one that they tend to pass over and hand over, whereas everything else, they are more likely to want to learn. I want to learn about my marketing. I want to learn about my conversion ratios. I want to learn about my SEO. I want to learn about, my videos and they learn everything. But I think finances is the one that you really need to look at, because everything you do in business has a financial impact. Because every decision you make, when you wake up in the morning, you turn the light on, you'll be incurring a cost. If you open an email, that will have a financial impact because you could have made a sale. If you ignore an email, you could have lost a sale. So literally every decision you make will have a financial impact. So if you think about that, you will start thinking about your business in a very different way. And you then start aligning different strategies, aligning with your financial strategies, because they do not stand alone. Your business is an entirety. Your business health shows up in your finances in the same way that your personal health will show up in your personal blood tests and things like that. So where you go to the doctor, first thing they'll do is say, you're not looking so great, you run a whole load of tests on you. In the same way for your business is looking good or looking bad, you look at the diagnostics behind your business. It's learning the vocabulary, and it is intimidating at first, but it's the first word. It's like, what is your revenue? What impacts your revenue? What impacts your costs? It's an information layer by layer, like an onion. And you go, why? What decision will make my revenue change? And revenue is essentially a function of the volume you sell at and the price at which you sell them. Then there's two things that you can change. You can change your pricing and you can change the volume. What actions can you do? Can you change your prices? What do you do about changing your prices? Can you reduce the cost of production, or will the market tolerate you increasing your prices? Will your customer tolerate you increasing your prices? What can you do about changing your volumes? Is it about your sales strategy? Is it your marketing strategy? What is the quality of your leads? This is why it leads to thinking about your finance in a completely different way. So what does financial management look like? You need to understand what goes on behind your numbers. You don't have to know how to do it. You don't have to go calculate all this stuff. You can leave this stuff to your bookkeeper and your accountant, but have sensible conversations with them. In the same way you go to a restaurant, you do not need to know how this dish is cooked, but you need to know when it arrives in front of you, whether it's a good dish or whether they're serving you something like this. So it is as important as this. So this is an example of a profit and loss. And this is an example of understanding the thinking behind making decisions around your business. And it's understanding things like what actually being in profit actually means, what being in loss actually means, and what does breaking even actually mean. And understanding the lines behind it. So your sales revenue is literally money you get in from selling your goods and your services. Your cost of sales are also known as your direct costs, because they are directly related to your sales revenue. And sometimes people get the lines of this mixed up, because things like marketing, people sometimes put into cost of sales, and it isn't a cost of sale, because even if you spend money on marketing, you're not guaranteed to get a sale. Whereas if you have labor costs or the cost of buying some goods or the cost of your labor in delivering a particular project, they are directly correlated to you making a sale. So when you understand that, then you can work out whether your products are profitable or whether your services are being priced correctly. And it's very important when you are service-based that you are covering the number of hours you're allocating to a project. Think about all the other costs that you incur simply because you have done this project. And this gives you a gross profit. And gross profit is a good way of measuring you across the industry, because if it costs you more to produce a product or produce a service, then you are either being very inefficient or you are not, or your gross profit is low, then you are not charging enough. So it's a very good indicator as to how you are performing. Now, the overheads are the fixed costs. These are the costs that you have to pay out irrespective of whether you make a sale or not. So if you made 0 sales at any particular period, you're still paying these costs. It's the cost of standing still, as I'd like to call it. And so when you understand the 3 categories, then you know what your operating profit actually is. And then it's your operating profit on which you get taxed. Now, a lot of people stop and think about gross profits, whether they're profitable. They're not thinking about whether they've got the fixed costs. And this is where it can send their decision making a bit belly up, because they I'm buying something for £5, I'm selling it for £10, I'm making a profit. But actually, unless you're selling enough of those products, you may not be covering your fixed costs. And this is where it comes about understanding what breaking even actually means. So, for example, in the 3rd column, you are seeing somebody who actually his gross profit is 10,000, and somebody who doesn't understand the concept of fixed costs might say, "Oh, okay, I'm making a profit. I'm happy." Quids in and and go skipping off down the street. But they've actually got overheads to actually cover, so you're only breaking even at that point. Now, a good way of understanding how many products or services you need to sell is understanding a thing called contribution. And the contribution is seen as the gross profit per unit. So say, for example, in the example I said earlier on, you have a product, you sell it for £10, you buy it for £5. So your gross profit for each product is £5 per product. So that is called contribution, because every time you sell a product, you're contributing £5 towards paying your overheads. Now, if your overheads were £500, you would have to sell 100 units to cover your overheads. So you're not making any business profit or any operating profit until you sell 100 products. So this is really useful for you to know how much you need to sell, what products you need to sell. And if you've got different profitability across different products, you start selling what combination of products do I need to sell in order to cover my fixed overheads. Okay? So running your business is really important to understand the cash flow and working capital. So when you understand how much you are selling, what your revenue on selling your products are, then you have to start managing the ins and outs of running your business with regards to working capital. So the working capital is basically the amount of money that needs to sustain your business. It's the buffer of that money goes into your company and out of your company at any moment in time. It could be £100 flowing through your company. It could be £10,000 flowing through your company. But it's basically what you need to keep the cogs going around in your business. You also need to manage a cash flow, because you need to know that you can afford to pay the periodic payments, things like your VAT, your tax, your self-assessment, all the periodic payments that need to come up. Maybe you need to renew certain licenses, your insurances that you need to come up. So if you're in the legal industry, your insurance, your indemnity and your professional insurance is very, very, very high. And some legal firms can go bust because if they cannot afford to pay that off in one lump sum, because a lot of insurance companies do not allow by payment installments. And if you don't have that lump sum, you cannot possibly trade without your certain licenses. So you need to make sure that you have the money to pay for that. Then you need to manage your debtors and your creditors. Just because you've made a sale, somebody owes you money, that is not profit until they pay you. So you should not start celebrating. You need to get that money in, and you need to make sure that you have your sales contracts in place so that you are able to chase them, because this then comes into the processes around your business, around whether your business is effective. So your debtors are really high and your creditors are really low, then you're not best utilizing your debtors and creditors, because what you want to do is you keep your debtors low because that cash belongs to you, and then you hang on to your paying your creditors as long as possible within your terms, because you're hanging on to your cash again. You basically have to utilize it. And then, but you don't want to be alienating your creditors. So you want to be paying them when they're full due, because they may withdraw selling to you if you annoy them and upset them by not paying them. And they won't give you good pricing either. So it is a balance behind paying your debtors and creditors. You'll also want to be paying yourself dividends and taking money out of the business. And how can you afford to know that? So you need to manage the cash flow in order that you can actually pay yourself in order to run your business. Then you have to go on about capital expenditure. If you are a business that has high capex, you are, a manufacturing company, that you are, or you're building a tech business, you need to make sure that you have no money to spend on your capital expenditure. So you need to understand what your ratios are, what you need to run in your business, to work in your business and your working capital. So when it comes to what kind of level of accounting and financial support you need, this is a very rough guide. It's only in my eyes how you see it, or how I see it. So when you set up in a business, you typically will need an accountant, because you won't be able to file your annual accounts. And so at minimum, you'll need an accountant to do that. Then you can start recording your own accounting records. You can do this on software, like spreadsheets or in ledgers or notebooks or whatever it is, or you can use your bank account if your bank accounts are more complicated, like not complicated, but the ones that give you more information, like the online challenger banks. Sometimes it helps you tell you what you spent your money on, and it gives you those level of details. You also absolutely need a financial plan, because this is where I say it doesn't matter how big you are, it just means your numbers are simple. But if you have an eye on your numbers, you can just build on it. But if you start having a very complex business and you suddenly start wanting to build your numbers, it becomes very overwhelming. Whereas if you start small and just add one number on as you get bigger and say, oh, I need more sales, different sales lines. I might have online sales, I might have physical sales. Then you start breaking it out. So you just add it gradually. But if you suddenly go like, I've got sales, and you're suddenly making £100,000 worth of sales, thinking, what is my sales made of? It becomes very overwhelming. So if you start separating your numbers out, and it's a bit of like admin, it's like sorting your wardrobe out. You shovel everything into your wardrobe, you can't find anything, it becomes very complicated. But if you have a few items and you separate it out, it's much simpler to start adding things in and organize it as and when you need to. So as you get bigger, the reason why I've said a 90K threshold is because that's when you are VAT, you need to be VAT registered. But in terms of what you need to start looking at in future, the next by 2025, is HMRC in the UK need you to start anticipating around the £50,000 mark whether you should be VAT registered or not. So the threshold, when you start thinking about £50,000, what services you need. So you need to start thinking about having accountants, your bookkeeper, to start taking the admin away from you. You need some level of accounting software, whether that is provided by your bookkeeper and accountant, or whether you have it and you both have access to it. That is totally up to you. Clearly, the bank accounts are, absolute necessity, without doubt. And then you start needing to thinking about, forecasting your cash flow, and then understanding your profit and loss forecast, because managing your cash and managing your profitability, there's a slight difference between managing cash, forecasting your cash, and forecasting your profit and loss, because there's different things that affect it. For example, there are things that you might spend money on, something like a piece of equipment, like a computer. That does not hit your profit and loss, but it hits your cash flow. And also there might be timing differences as well. And so things like VAT, so you're collecting VAT, which affects your cash flow, but it doesn't affect your profitability, because that money doesn't belong to you in terms of profit terms, but you need to pay it out to HMRC. So you need to reflect that in your cash flow, but not your profit and loss. So there are little things like that when it comes to understanding those sort of things. When you get bigger, then you really start need to think about, managing your business, thinking about strategically around your business, what you need to do. Definitely start thinking more about your cash flow forecasts and your profit and loss forecast, because this is when you start thinking about, what am I selling? Who am I selling it to? Start playing with your, if I change my price, what does it do to how much of the volumes I sell? If I have a new idea about a new product, what does it do to my business overall? You start thinking about financial modeling, which is what I think about, like financial Play-Doh, and you play it out on paper before you do it in real life. So you don't go launching a new product or designing a new product without thinking about how much it's going to cost you, how much you're going to sell it for, and you start playing with it. And because something is new, financial forecasting, think of it like like a recipe. If it's new and it's untested, then you need to keep sampling it and go like, oh, are the numbers I estimated any closer to what is coming out in reality? Whereas if you have some experience of it, there is less testing involved. You go like, well, I know month on month, I'm typically selling £5,000 worth of products. I'm selling, 50% of product A, 50% of product B, because you get a sense of what it runs around your business. This enables you to make instinctive decisions without having to crunch numbers. But without having to know the numbers in the first place, it makes it much more difficult to run your business instinctively, because you're not really sure as to how it pans out at the end of the day. So understanding your numbers, by understanding your budgets, by understanding your forecast, and what every action you do has in your numbers, will help you make much better quality decision making around your business. Finance management tasks, what do you need to do on a weekly, monthly basis? So typically on a weekly basis, you absolutely have to be looking at your bank account, making sure that you are matching all your payments in your bank account to your invoices, your purchase invoices, keeping the records of them, and then chasing your debtors down on a weekly basis. On a monthly basis, I recommend you look at making sure that you have understand what you have made in the monthly basis, how much you have made in that particular month. Try and understand what you expected to make in that month and whether it was a good or a bad month, because then it enables you to say, oh, I had a really bad month, I need to make more sales. Or if you had a really good month, you can go, oh, why was my month really good? Because if you understand what makes you a really good month, maybe you can replicate it and have a second month because you're actively managing it. So one of my analogies is for that is like, oh, if you're selling ice cream and you go like, oh, why did I sell all my ice cream today? And you think, oh, and you look at it and you say, oh, it's because a whole load of tourists turned up, and think, okay, so then you actively think, when are the tourists next coming in? And think, do I need to buy more stock of ice cream to sell? Because if you don't think about that and just think, oh, I had a really good month, and just pat yourself on the back and walk away, you may be walking away from opportunities that you didn't know existed and were right in front of you. So pick the low-hanging fruit from your business. Diarize the key dates so that you know what you need to do when, because you don't want to be in a panic, and you don't want to panic your accountant as well, because if you manage things better, you get much better advice, because nobody has time for you when they're stressed. So if you're doing your tax return, your personal tax return, it's not due to January, you can submit it right now. There's nothing wrong with you submitting your tax, because all the data is ended now. You've got your records together, get it all together, give it to your accountant, and then you can discuss why things are good, why things are bad. They'll have time and capacity to give you good advice. So make use of that time. Don't ask them advice in the middle of January when he's got 100 people barking down their backs at them. So you need to manage your sales invoices. Make sure that you're sending out sales invoices immediately, because then you can chase them down for your debtors. Make sure that you have the right details on your invoices. Make sure that your invoices are dated correctly. Have a system for doing it. I recommend that you have a process for doing things, because when you have a process for doing something, you can then hand over that task. When you get too big, it's very difficult when you're busy to hand over tasks. I hate it. I think I need to hand over certain tasks to people, but because there is some things you can't create a process for, but some things you can create a process for. It's so much easier to bring on a virtual assistant, an executive assistant, a bookkeeper, whatever, and say, look, this is what I need you to do, and this is how I do it, rather than sitting down with them and go like, well, you need to do this, 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 and this, and this. It's much easier to give them a document and say, this is how it's done. The files are here. This is how you do it. So you will save yourself so many headaches if you create a process right from the get-go. If you do something more than 3 times a week, then you create a process for it. That's my recommendation. So we all need to get over our fear of finance. I know we all hate it, but sometimes you just have to bite the bullet. If we want to lose weight, we're going to have to go on a diet and do some exercise. There's no amount of thinking about it, worrying about it, that is actually going to do anything about it. You actually have to take action. You'll find it less intimidating if you find somebody who can help you, who can sit on the same side of the table as you. Because I was talking to another client, and she said, I wish my accountant told me the things you told me. You've got to go and find the right accountant. I know Alexa here has a really lovely accountant. He's absolutely lovely. There are loads of lovely accountants. If your accountant annoys you, go find somebody else. There's no reason why you should tolerate bad service. If you don't understand what they're saying, then it's their job to explain it to you. They are there to take away the stress and anxiety around running your business. Because the minute you have less anxiety, you have more clarity around your business. Like I said earlier on, you will understand the changes around decision making around your business. You will understand changes in prices. What happens if a new competitor comes into the market? You need to know what you can do when somebody else enters the market and they undercut you. Can you afford to change your pricing? If you don't know that, then it becomes you become sort of a bit like a lost ship at sea, go like, I don't know which direction I should go into. You don't know how you perform against your other competitors if you don't have your clarity around your finances, and you don't have any understanding about any slack in your business. So if you have a member of staff or you have a freelancer, you're paying them, and if you don't know whether you're utilizing them to full capacity, then how can you do better? How do you know whether you have a decision that you can take them on as a part-time instead, or take a freelancer on as full-time staff because it's cheaper for you to do that? There are so many decisions that you can make by knowing your finances. So try and swallow that frog by learning the language of finance, because it literally is just learning the vocabulary around it. In the same way that you as a business owner, you've learned to register with HMRC. What next? You learn the next step. Understanding your finances will be very much like that. Just learn the vocabulary step by step by step. It's very, very manageable. You just need to know what it means and not necessarily how you do it.
Well, thanks, Julie. We need to be pulling some questions. We've got some questions coming in, but that's great. Well, have you got a slide with your contact details? And let's have that.
Contact details. I think I do.
Yeah, but we can certainly we'll be sharing Julie's contact details. Julie is a member of our UpCoach online community, so we will post the recording of this session there, and we'll certainly share Julie's contact details. And I know we are just on time, but a couple of questions have come in, Julie. I don't know if you've seen in the chat.
No, I haven't. I'll stop screen share then, and I can see everybody then.
Okay, thanks. There's just some specific questions from Cedar around the difference between, I've just lost the question, VAT, yes, it's VAT, standard rate, reduced rate, and zero rate VAT. And also